Welcome back to the Financial Symmetry Show, where we are all about enhancing your today and enriching your tomorrow. You, our listener, likely have had this conversation with people in your circles, your family. We just went through Thanksgiving. Obviously, you might have had this conversation about different prices with things that you're buying increasing. And the reason is we've had historically low inflation rates, right, for a long period now, Mike.
Yeah, I mean, the last 10 years has seen inflation around 2% a year. And so just back up a second, inflation is normal. And that just means that the prices rise typically every year. On average, since the 1920s, that has averaged about 3% a year. So if you buy something that's $100 last year, it's usually $1, 103 this year. And that number, the last 10 years since the Great Recession, is averaged about 2%. So it's been lower. So now that all of a sudden, in October, the big headline was year over year inflation was at 6.2%. So that means the goods and baskets that the government tracks every year increased 6% year over year. So that obviously, from the media perspective and from everyone's day-to-day living, kind of notices that big increase in terms of rising prices. Now, it's not across the board. Depends what you're buying. Some have gone up more than 6%. Some have gone up less than 6%. But it's definitely felt a lot more in the pocketbooks now than maybe it was in the past. And I always like to say that, inflation is one of those risks that doesn't show up on your account statement or in your bank account, but does in the grocery store or the gas station. Like I said before, if it normally costs you $40 to fill up a tank and now it costs $60, then you're definitely feeling it there, as well as other purchases as well. And so really, we're going to talk about kind of what has happened historically. What are some of the drivers that was going to result in inflation continue to go up, and what could result in it going back to more normal levels, and what you can do about it with your portfolio?
So yeah, that takes us to the next idea here as why should people care about inflation? But let's talk a little about some other impacts on how you should be investing or how you should think about the way you have your portfolio structured.
Yeah, no, it's like I mentioned before, some like to call it the silent tax. I mean, it's a reason why we own companies or stocks or equities, whatever you want to call them, is because those companies have the ability to raise prices, increase their earnings, manage their costs effectively. Since 1970, the global markets have gone up 70 times, and the inflation has increased 7 times. So over the long term, owning companies or stocks have been a great hedge against inflation. In the short term, sometimes it's mixed result, but really we're focused on the long term here. That's one thing that can help, is obviously you're not being too conservative with your portfolio. The second thing is, if you're working, you should, for the first time in a while, should have some leverage in terms of wage inflation. Wage inflation is where your annual raises are provided, because there's so much demand for labor today, that you should be able to result in higher pay than maybe you were the last few years as well. So that higher pay helps offset the higher costs you have. If you get a 4% raise and inflation, increases by 3%, you're actually getting a positive 1% return there, a real return. Where the alternative is, if you don't get a raise and inflation goes up 3%, then obviously you're paying more with less dollars. So it's good also if you have a fixed rate mortgage. So if you have a 30-year fixed rate mortgage, we've talked the last few years about low mortgage rates and the benefit to refinance. So if you have that, that's great, because your dollars are hopefully everything is increasing in value, and the mortgage payment stays the same. And so that is a positive sign. Where it's bad is if you have a fixed pension or annuity. Maybe you're retired and you have a pension from your work that doesn't increase every year, or you purchased an annuity that just pays the same amount for the rest of your life. That's a little bit more challenging, because that money that you receive every month is going to be worth less and less. It's a reason why we feel that, once again, that owning companies or stocks is your best long-term hedge against inflation. And then finally, if you are retired or soon to be retired, delaying that Social Security is another benefit, because that is one pension where actually it does adjust every year for inflation. So if you can wait to claim Social Security as long as possible, that would only result in larger increases year after year with if inflation doesn't deter or decline over time.
Yeah, it can be really tough to hold the amount of stocks in your portfolio, though, if you're in that phase of life and retirement, right? And we talked a lot about that on the podcast in our previous episodes, because volatility can make it hard to sleep at night. However, it's one of the most sure ways to benefit you over time against that rising silent tax, you call it, of inflation against your portfolio over time. So let's dig in a little bit more here and talk about just some of the historic perspective and maybe of what we're experiencing now that you touched on a little bit in the beginning of the reasons for persistent high inflation. Like that's the fear, right? That we all feel that it's going to be a persistent level of higher inflation that we've seen in pockets in the past.
Correct. Yeah, I mean, that's kind of the number one challenge from our view from economists today is whether or not this is going to persist like we saw in the 1970s, or is this just, hey, everyone was stuck inside in 2020 and now they can spend their money and that's driving up prices. And that will, once a year or two, and we get some of the supply chain issues, such as the chip shortages figured out, then actually, inflation will subside and go back to kind of more normal levels. So, historically, like I said, in the 70s, it was primarily driven by supply shock. So we saw obviously with oil and gas kind of an issue there that drove up, prices. We've also seen higher inflation, where after World War, especially World War I in Germany and the Weimar Republic, that's where, Germany owed money in a different currency, which resulted in them, printing more money than they could pay back. But it really comes down to a mindset. If people, like I said earlier, if they think prices are going to rise, they're going to, buy now versus kind of wait till later. But whether or not it's going to stay persistent or not is, some of these supply chain issues, like for example, if you're trying to buy a car, as I mentioned, that just they don't have the chips available. But someone told me one time the biggest solution to higher prices is higher prices, because what happens is other people see that these prices are higher, like we saw with lumber. I think in the summer of 2020, is more supply comes on the market, and then that drives down prices. So right now, assuming manufacturing a new plant that makes those chips takes a while, but once that comes in online, will that provide enough supply to bring those prices back down? The big wild card here is, which is still trying to figure out, is some of the fiscal stimulus, such as the recently passed infrastructure bill. And then I think that the current negotiation among I think it's called Build Back Better plan, which I think is still in negotiation as we have this discussion today, that is going to put more demand into the market, but is that going to persist? How long will that persist and drive up prices is too early to tell.
Yeah. So anytime you're looking at an issue like this and trying to make decisions for your investments on how it may impact things and how you have it structured, discipline comes back into the picture, right? And building a durable portfolio that can sustain and basically take the hits of things like this so that you don't have to react right off the moment. So with that in mind, let's talk about the investment options. And we talked about some of these in the podcast we did earlier this year, Investing for Inflation, but let's dive in a little more, because I think this is going to be a more meaningful conversation for many people now that it's at the forefront of our minds, right?
Yes. And I'll say it again, I think it's the third time I'll say it again. Global stocks are a great long-term inflation hedge. Companies can raise prices, increase earnings, profitability, raise dividends. That is probably number one. It's not, the short-term hedge is mixed, but it's a great long-term investment. If you go further into detail in terms of global stocks within different categories, small value stocks have typically done the best among the different kind of types of companies. That's probably worth another podcast or a different discussion, but that's kind of the area to go. And for those financial symmetry clients, that is an area that we're focused on for our clients today. And then the second item, as we mentioned before, is those treasury inflation protected bonds or TIPS, ICE savings bonds. You probably also hear about in the news. What they happen is their principal increases over time with inflation. I kind of look at them more as like an insurance policy, kind of like you may buy a homeowners or auto policy on your house or car. The challenge is they're very expensive right now, and historically their returns have been a little bit below buying regular bonds because you are paying for that extra insurance. The other thing I'd mention is try to limit your cash beyond your emergency savings, just because there is a cost to holding that cash. You may not see it, as I said. It might not come through your bank account statement or your investment account statement, but that cash, does decline over time. If your interest is 0% and inflation averages 3, 4, or 5%, obviously that value of that dollar is declining over time. Short-term bonds, I think, is a good kind of overall hedge for that money needed the next 5 to 7 years. It's not taking as much risk as stocks for the shorter term, but it's also not taking the same risk as longer term bonds if we do have, longer persistent inflation. So shorter term bonds that mature in the next, 5 years or so, 0 to 5 years would be a great kind of interim term inflation, because we do see rates continue to rise, or rates rise, the rate or the interest in that portfolio would increase as well. The other item, as I go down the list here, and I don't have a few items here, is probably the most popular you hear about is real estate. I need to buy that house, I need to buy that rental property because it's going to go up in price. I would say there's pros and cons to real estate. As we've seen this last year, real estate has done well, but it also depends on the price you're paying. If you're buying one property down the street, there's a lot more risk than buying, 100 properties through a manager who's managing a fund of properties, or buying a real estate investment trust that owns 200,000 properties throughout the world. So I do think owning businesses or real estate is a good thing. It's just make sure you're buying it at the right price versus, blindly purchasing real estate thinking that the prices will go up over time. In addition, we mentioned before with Social Security, just if you have the flexibility, delay that as long as you can, just because of that ability for that inflation increase over time. And then finally, the three ones you don't hear a lot about, or you hear a lot about it, but we're probably less optimistic on, would be commodities. These is oil or silver or some other type of, commodity item. The results there, people don't realize you're not actually buying the commodity, you're buying futures contracts. So there's other concerns or risks there. So your returns might not fully reflect, inflation increases. Gold, which obviously gets a lot of headlines, has not actually done that well this time around with kind of the inflation concerns. Its performance is kind of mixed over the long term as well as during inflationary time periods. And the one probably getting the most headlines today is cryptocurrency. Obviously, Bitcoin is kind of the headline there, but overall, as cryptocurrency is getting a lot of headlines given the concern over, money and inflation, but being only around for 10 years or so, the results are mixed, and I would not overweight your portfolio towards something that is relatively new investment option. So that's kind of the level of options decided. As you kind of can tell, global stocks is our first choice, and then there are some other choices from there.
Summarizing here, Mike, supply chain issues, transitory, a lot of different words we're throwing out here around inflation as it relates to the investment strategy. But let's bring it home with the progress principle ideas of what we talked about here today.
Yeah, I mean, we're not economists. We don't know if it's going to be temporary or permanent. I think it's important to stick to your plan, stick to your financial plan, stick to your investment plan, focus on the things that you can control with your investment plan. Like I mentioned before, those global stocks, US and international companies are great long-term hedges against inflation. Make sure that money is set aside for the money needed in the next 5 to 7 years. Focus on, taxes. Obviously, this is tax season. We did a previous podcast on year-end tax planning. That's money you can control in terms of how much you're paying the government to see if it's you're doing everything you should be there, how much you're saving, controlling your spending, and then you're insuring against those unexpected risks. So I think the key takeaway I would take away is don't let the media dictate your financial decisions. Stick to your plan. If you don't have one, obviously, work with a financial planner. We recommend a fee-only financial planner to help you reach your financial goals.
Absolutely. Understanding what you need from a portfolio in the beginning with your financial plan is one of the most important aspects to a customized financial plan and how you're building your investment strategy. And many people skip that step because it's more fun to pay attention to headlines and invest in the things that have been doing well. So you're talking about that. And it's that power of the FOMO that we talk about all the time, the fear of missing out, because you hear a story around, and some of us are more predisposed to think like that than others, but it is a risk, right? It could be a benefit, but you got to be right over and over and over if you're using that type of investment strategy. And it's one that hasn't been able to be proven to be consistently done over time. So that's why we stick to the disciplined. Some people call it boring.
Yep. Investing should be boring, but it works.
Yes. But it's harder than you think, right? Because you have these risks coming at you. How many talking heads are out there now that you're listening to through either your phone, the radio, TV to an extent, right? Conversations with friends. So we're here to help you build a strategy that can protect you from some of that.
Go ahead. Go ahead.
I was going to say, if you haven't worked with a financial advisor before, reach out to us. We can connect you with an advisor here at our firm or another advisor in your area to help you build that plan and get started on your journey so that you can have a more fruitful and enriched retirement down the road.
No, I will echo that, because I think one thing we'll do is help you manage your emotions. I mean, we were doing similar podcasts a year and a half ago when people were getting scared and wanting to sell stocks. Now we're doing a different podcast where people are, looking to buy the hottest new investment option. So, this is where someone can help you reach your goals and not focused on, making decisions that could impact your long-term success.
And that's another point. You want to look back at somebody you're working with to see a track record of what they've done in the past, right? We have over 150 episodes of our podcast, videos, over 500 articles going back to 2007. So you can read our views and see what we've been helping clients with through that time frame and how we were coaching or writing about our decisions at those times. Because once you put it in writing, right, you can look back and sometimes say, oh, well, okay, I can see either how I was wrong or right in those circumstances, but you have a plan. And that's the important part that you can stick with, and it's durable. So we encourage you to do that. And thank you again for joining us. Thank you for the feedback, and hope that you can join us again. We put these out every 2 weeks if this is your first time.